Your pension might be worth $1.2 million, and I'm going to show you the one decision that could result in you giving up nearly half of that value without even knowing it. As a certified financial planner and lead wealth advisor here at Peak Financial Planning, I've seen too many retirees make the wrong, extremely costly decision when it comes to their pension. Let me tell you about Richard. He's an engineer who spent 32 years with the same company. And when I met him, he had his pension election form literally in hand and was ready to be signed. He told me, "I'm getting $4,200 a month for life. Not too bad, right?" I agreed. And I asked, "Richard, which option are you planning to take?" And he looked at me a little confused and he said, "I didn't know there was more than one option." He handed me the form and I reviewed it and said, "Richard, did you know that if you sign this form right now, as it is, your wife will get nothing if you were to die?" Richard's eyes went wide. He said, "Well, of course, I want my wife to get something when I pass. How's she going to survive without this money? I just thought I was supposed to take the highest amount." I told Richard not to worry. We're going to build him a dynamic retirement income plan that will help us answer the question of how he should elect on his pension form. First, I showed him what the pension was actually worth. To replicate $4,200 a month in retirement income, he'd need about $1.26 million saved up. He'd been thinking of this pension as just a monthly paycheck, but it was actually a seven-figure asset to him. Then I showed him the dramatic change in his retirement probability of success based on how he claims his pension. His wife, Susan, is 6 years younger than him, and statistically, she's likely to outlive him by over a decade. If Richard lives to 78, which is around the average for men his age, and Susan lives to 88, that's about 10 years she'd be receiving benefits after he's gone if he had chosen the joint and survivor option instead of the single life option. So I ran the numbers both ways. With a single life option, Richard would get that full $4,200 a month like he mentioned, but when he dies, Susan gets zero. The pension just stops. And I calculated the present value of Richard receiving $4,200 a month from age 65 to 78. That's 13 years of payments. Then I showed him the alternative, right? With the joint and survivor option, Richard's monthly payment would be reduced to $3,600 a month. So yes, he would be getting $600 less each month while he's alive. But here's what changes everything. When we calculate the present value of Richard receiving $3,600 a month for those same 13 years, and then Susan continuing to receive $3,600 a month for an additional 10 years after Richard would pass, the total value is significantly higher, as you can imagine. In fact, Susan alone would receive about $432,000 extra in benefits after Richard passes, money that she received nothing of had he gone with his first option and signed the document before he walked in. I believe it was about then when Richard sat back and literally told me, if I hadn't come in here, I would have signed that form tonight and had it in the mail by tomorrow. But here's what really sealed the deal for Richard and Susan. I showed them how their pension plus their Social Security income would actually cover pretty much all their basic living expenses. And this is something that not a lot of people think about. When you have guaranteed income covering your essential needs, like your housing, utilities, food, insurance, and healthcare, you can actually spend more overall and feel more confident doing it. Research shows that retirees with guaranteed income sources spend more freely than retirees relying entirely on portfolio withdrawals. Now, you might be asking yourself why? Well, because there's no fear of running out. The baseline expenses are secure and their portfolio is able to handle just their variable expenses. For Richard and Susan, their combined pension and Social Security would provide about $78,000 a year. Their fixed expenses were right around $80,000. So they were almost perfectly matched up. That meant that everything else, their travel, their big entertainment, their gift to grandkids, if they're going to be doing that, helping their kids, all could come from their investment portfolio. And because their needs were already covered and taken care of by their guaranteed income sources, they could afford to keep their investments more growth-oriented without losing sleep over market volatility. When I stress tested their plan with the joint and survivor pension, they had a 96% probability of success over a 30-year retirement, even accounting for market downturns and higher than expected inflation. Now, with the single life option, which Richard almost signed if he would have passed at 78, Susan's probability of success would have dropped to 59%. So she'd have just over a little bit of a coin flip's chance of running out of money in her 80s and late 90s. So let me give you the pension claiming checklist that we gave Richard and Susan to make sure that their final decision was appropriate. These are the critical questions that you need to ask before you sign anything. So question one is, does this help me or really hurt me? If you're staying in a job that you really hate just to max out your pension, really run the numbers. I've seen so many people work 2 or 3 extra years for just an additional $100 or $200 a month. Meanwhile, their health is declining and they're missing time with their family and friends. Sometimes just enough is enough. And so calculating what those extra years actually add up to in your monthly benefit, and then deciding if that's worth the trade-off. Now, question 2 is, can I do better elsewhere? And what I mean by that is if you do have the lump sum option available to you, which most do, go out and get quotes from private annuity companies before you decide. Sometimes the private market can actually offer better terms than your employer's pension. So higher monthly payments, better survivorship benefits, and maybe even death benefits for your heirs. So we had this client that had an option between a lump sum offer of $280,000 or a joint life pension of $1,200 a month from their employer. Just to keep things simple, it's about a 5.1% annual payout. So we recommended that they shop around and they look at private annuities, and they ended up finding a great company that would pay them $1,350 a month. So that's $150 more than their employer's offer, plus included a death benefit for their daughters as well. So they got higher income and inheritance protection just by shopping around and rolling over that lump sum. But here's a big warning, and this might not be super favorable in the financial advisor industry, but be very cautious if an advisor just plainly tells you, just take the lump sum and let us invest it. We can beat the pension. Yes, the stock market averages higher returns over time, but in retirement, averages don't really matter that much. Sequence of returns matters. If you retire right before a market crash and you're pulling income from that portfolio, you can run out of money much quicker, even if the long-term average would have been fine. I hope that makes sense. Now, what I mean by that is, with a pension, the check shows up every month, whether the market's up 20% or down 20%. Comparing a pension to investing in a lump sum is not really comparing apples to apples. You're comparing a guarantee to best efforts. So make sure you understand the difference before you give up that option of guaranteed income for yourself and your family. Now, question 3 is, what happens when I'm gone? This is a question that changed everything for Richard, as you heard. If you elect the single life option and die early, can your spouse maintain their lifestyle? Will they have to sell the house, cut back dramatically? For most married couples, especially when there's an age difference or a health difference, the joint survivorship option tends to be the right choice. Remember, when one spouse dies, expenses typically only drop about maybe 25%, not 50%. So you still have the same housing costs, utilities, and insurance, and most fixed expenses pretty much stay exactly the way they are unless they move or downsize. But you do lose one Social Security check, even though that spouse will get the higher of the 2 Social Security checks. If you lose the pension too, that can be a devastating income drop right when your spouse is really most vulnerable. Now, our 4th question is, how does this fit in with the whole picture? Your pension doesn't exist in isolation. It needs to work alongside your Social Security strategy, your investment withdrawal plan, your tax situation, your healthcare costs, and even your legacy goals. I've seen people make a great pension decision in the moment, right, in the vacuum, that creates problems elsewhere within their plan. They start with their pension early and they didn't need it and they lost precious tax planning years. Or they take single life to maximize their income like Richard was thinking he would do, but leave their spouse completely exposed. Or they delay their pension to get a higher benefit, but they're forced to drain their IRA at a higher withdrawal rate in the meantime if they retire earlier than expected. So you have to see how all these different pieces fit together and really fully understand the trade-offs that you're making, because at the end of the day, retirement planning is just about identifying and being comfortable with the different trade-offs that you're going to have to make. Here's the bottom line. Your pension might be the most valuable asset you own, but only if you make the right decisions about how to claim it. Richard almost gave away over $430,000 in lifetime benefits to his wife because he didn't know that there was more than one option, and he didn't understand how to really evaluate them within the construct of his own plan. So make sure you don't make that same mistake. If you need help analyzing your specific pension options and building a comprehensive retirement plan around them, I've put a link in the description below where you can schedule a call with my team. In our planning process, we'll review your pension election choices. We run stress tests to see the different scenarios and how it interacts with your other retirement income, and we'll show you exactly how your options will impact your expected retirement paycheck over a long retirement. So don't leave $432,000 on the table like Richard because you didn't ask the right questions. I hope you found value in today's video, and I look forward to seeing you in the next one.